This is horrifying. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, the world is running out of money as another major economy plunges, and we've been warning that the combined actions of global central bankers would eventually hit the global economy. And it's not just one country we're now seeing several economies around the world starting their downward spiral. And we mentioned that eventually this would come to American shores. And if you're wondering what we're doing in the Caterpillar factory today, well, we now have the first signs of evidence that the downturn is finally here. Plus, we have a sponsor for today's show. You might remember Shapeways, the 3D printing company. You can find them on the NASDAQ under the symbol SHPW. We're going to show you a technical setup. If you are a technical trader, we're going to show you this stock just came out of a deep supply zone from oversold territory. Momentum's building, and we're going to show you what the catalyst could be to send their stock up as much as 33%. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's head over to Bloomberg, where we pick today's story up as we go looking for money. The Swedish economy stagnates as rate hikes weigh on output. And finally, you're going to hear more and more headlines about rate hikes being the problem. It's not the actual hikes themselves that are an issue. As we know, it's the inverted yield curves and money curves that have caused an issue with banks not creating enough new money because they are now constraining the growth of credit in a debt-based economy. Credit expansion is absolutely critical for the economy not only to grow, but for the existing debt to be serviced. As gross domestic product adjusted for seasonal swings was unchanged in the third quarter from the previous 3-month period, this according to preliminary data. The development was weaker than expected, which we're going to hear a lot of those words in the future months by economists who had penciled in growth of 0.3%, following a slump in the second quarter. And so what you see is economists were suggesting that we're going to see a soft landing. We told you it's not going to happen, and the evidence is mounting. The data comes after Sweden's economy had appeared more resilient than foreseen amid elevated inflation and rising borrowing costs. Still, the Nordic country is set to experience a deeper contraction than most European countries, as a high prevalence of variable interest rates make households, some of the world's most debt burden, sensitive to central bank tightening. And of course, in countries where they do have a lot of variable rate loans tied to their housing market, these higher interest rates, when these loans reset, if you can think back to what happened during the global financial crisis, which started here in the U.S., when all those variable rate mortgages reset, well, it's going to happen all around the world. Watch and see. But the issue here that many of these experts can't see, it's all about how central bankers impacted the banking system and caused the banks to constrain the creation of new credit. And here's the evidence. When we look at the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes, now we're looking at the U.S. data here against real gross domestic product, and economists are shocked. They're surprised that, of course, they're seeing a downturn in the preliminary data. And sure enough, what we can note is any time the banks start to curtail credit, you can see that when they tighten standards, that's any time the blue line's above the horizontal black line. What eventually happens to GDP growth? Well, it comes down, and that's what we see on the red line here. We see it in the global financial crisis, and we're going to eventually see it roll over, likely in the fourth quarter here for the U.S. and into next year. But it's not just the problem with GDP growth. Inflation's coming down as Eurozone inflation sinks to a 2-year low as economy contracts. And of course, this is a surprise headline because you think back, how many central bankers have said that inflation is sticky, it's not going away. We keep making the case that if you don't have enough money to sustain price growth, demand goes down. Sure enough, we're seeing the signs now in the Eurozone. And keep in mind, what happens there is also eventually coming to America. As consumer prices rose 2.9% in October, down from the previous month's 4.3% and better than the 3.1% median estimate, according to a survey. In a separate release, Eurostat said third quarter gross domestic product fell by 0.1%, missing estimates for stagnation. Of course, we know that stagflation is when you get rising inflation and rising unemployment. We made the case over and over why you don't see that for a prolonged period of times, and there seem to be surprised that demand is coming down, the economy is contracting, and lo and behold, with the shock, inflation is indeed coming down. It all just turns right back to the banks, all due to the actions, again, of global central bankers. And here you can see the net percentage of domestic banks tightening standards for commercial and industrial loans to firms of all sizes. Now we're overlaying the consumer price index. This, again, U.S. data here. That's shown in red on a year-on-year rate of change. And eventually when banks tighten standards and they constrict the creation of new credit, there just isn't enough money to sustain demand. And sure enough, what do you see? And CPI come down. You see that happen during the dot-com bubble, the global financial crisis, even here briefly following the 2015-2016 tightening that was almost a global recession. We see a little bit of downturn in the CPI with a lag, and now we're seeing it now. They just don't understand. It has everything to do with how the monetary system works. Unfortunately, the people in charge of it, well, they don't understand how it works at all. The economy is likely to remain weak for the rest of this year, but as inflation falls, this referring to the Eurozone, further household real incomes recover and the demand for Eurozone area exports pick up. The economy should strengthen over the coming years, and that is a fallacy of central bankers because there's a big component they're missing this. Yes, incomes can rise, but hours worked can shrink, and that is the issue they can't see, that if inflation doesn't go up, if companies cannot charge higher prices, they can't magically just give out raises because they don't have the money for it. And yet here you can see them just believing and hoping that real incomes recover. We've made the case that layoffs are what comes next. And despite the deteriorating backdrop, Lagarde stressed again the talk of rate cuts to perk up activity is premature, with officials' inflation mission still incomplete. Of course, we know that global central bankers will be racing back to zero at some point, and they won't see just how bad the global economy is going to come crushing down. But now let's take a look at the U.S. because employment costs are rising at a faster pace on pickup and wage growth, again suggesting that inflation, that wage price spiral that central bankers are worried about, that higher incomes will lead to greater demand and drive prices higher. They don't like that. They want to see wage growth come down, but nevertheless, we're not seeing it in the data, and that's causing some concern. But again, the part that everyone seems to overlook is the amount of hours worked, because you can give people a raise and then cut the amount of hours they work, and then all of a sudden they might be thinking they're making more money, but in reality they're not. The Employment Cost Index, a broad gauge of wages and benefits, increased 1.1% in the July to September period after rising 1% in the second quarter. And while wage growth picked up slightly within private industry, salaries at state and local governments surged. And while there are a number of earnings metrics published more frequently, including average hourly earnings figures from the monthly jobs report, which economists and we tend to prefer because it's not distorted by shifts in the composition of employment among occupations or industries, but notably, they left out, you see this, they left out the amount of hours worked. There's a reason why, because they don't want to admit that hours worked is slowing down as companies, and wait till we get to the Caterpillar data, and you're going to see demand is coming down, and that's not a good thing. Because what these experts don't seem to get is when we take a look at total compensation, now we're going to take average hourly earnings that they're fixated on, but add in average weekly hours. We're going to multiply the two together, put them on a year-over-year rate of change. That's colored in blue against the consumer price index. And what do we note? Of course, the consumer price index has actually outpaced wage total compensation. It's briefly above it now, but we should get some new data on Friday. Our expectations is total compensation going to continue to fall here, and it doesn't matter if inflation comes down because total compensation growth is going to fall even faster. Again, companies just can't make money up to give people raises. If there's no work, hours get cut, enough lack of work, people hit the unemployment line, and then the wheels of the U.S. economy will come off the bus. And we're hearing a lot more. I can't afford this as sinking Dallas Fed survey signals The economy is slowing as more evidence of the slowdown is now hitting the U.S. as the general business activity and company outlook indexes remain largely unchanged at minus 19.2 and minus 17.1 respectively, but it's getting worse. This is the 18th straight month of negative readings for the headline sentiment, and we made the case that this wasn't going to turn around. There wasn't going to be a soft landing. And sure enough, we're now getting some evidence that matches what we've been saying, is that hours worked are slowing down. Eventually, this leads to an increase in unemployment claims. As new orders are dumping again, this is coming from the Dallas survey, and the average work week, well, it's declining, which of course we take as absolutely no surprise. Which is interesting is now let's take a look at what's going on in Caterpillar, and then we're going to zoom back out and show you. We show you some smaller economies. Of course, the Eurozone is pretty big, but there's another major economy that's leading the downturn here. But let's show you just how fast this is coming to U.S. shores, when many of the experts kept saying the labor market here in the U.S. was going to keep the economy running. We said not how it actually works. As Caterpillar falls, a shrinking backlog stokes demand worry. This is a big problem, as Caterpillar's report showed dealer inventories have continued to grow while orders decline 15% year on year. And this adds that their modeling points to a slowdown in sales and earnings growth for the fourth quarter, suggesting GDP growth, as we've made a case, is also coming down. And as a result, their stock tumbled to the lowest price since early June after the company said that its order backlog shrank in the third quarter, and a sign of slowing demand for its iconic yellow machinery. And there's the evidence. If you don't have enough new orders coming in to keep your workers busy, you put them on the backlogs and you work through the backlogs. Now, all of a sudden, if you don't see a pickup in new orders, what happens? You have a bunch of idle employees. Eventually, you start trimming their hours back, as we've seen in the Dallas Fed survey. You trim those back enough, and eventually you put them on the unemployment line. And so we can see now the evidence that the global economy is running out of money, and we're seeing it not just in isolated pockets. The concern is it's actually an issue of a global synchronized downturn. Here's the evidence that, of course, we know unemployment claims likely to head higher instead of lower. As we look at the current new orders diffusion indexes for the Philly Fed, we love the Philly Fed data because it goes back to the early or late 1960s. We've got this overlaid against a 4-week moving average of initial claims, that shown in red. And sure enough, when you see a downturn, as you can see in new order growth, eventually you get an increase in initial claims. And you can see this rinsing and repeating over and over again here in the 1990s recession, the dot-com bubble, again, the global financial crisis. Right now, we saw a little bit of a resurgence in new order demand, but the early data that we're seeing, of course, Caterpillar actually validates this. The new order demand is coming down. Backlogs are getting worked through. And what that tells us is, again, that 4-week moving average initial claims is headed higher. And the problem is now, with the major economy, we look to China as home sales decline and slow in October amid policy support. We made the case where Chinese consumers are much smarter than the government thinks, that they actually can see global demand slowing. They go to work in the factories. They know people that work in the factories. What are they seeing as well? A slowdown in new orders. The backlog's getting worked through. And do they want to go out and commit to buying a home at a time, as we made the case, that the property developers, they're in the news almost every week now about their insolvency, how about their missing payments on their loans, and that, of course, comes all the way back to the banking system. And the difference here, again, between how homes are built in China and the U.S. In China, you buy your home before it's even built, and you start making the payments. So the risk is, if the builder can't complete it, you're out your money. At least here in the U.S., you only put a deposit down, so that's your loss. We said, of course, Chinese consumers, no way that they're going to be buying homes in this condition. And sure enough, we're right, as the value of new home sales among the 100 biggest real estate companies fell a whopping 27.5% from a year earlier. And this, of course, narrowing from a 29.2% decline in September. This is, again, preliminary data. This is just a big outright collapse. And China's years-long real estate slump has starved developers of cash. Again, coming back to where we started the show, is there just isn't enough money to sustain the economic growth that everyone has has hopes for and service all the debt. And because we're seeing such a contraction in the amount of money in the global economy due to central bankers, you can see it's affecting everyone majorly, including, of course, we know these China property developers. And they've delayed the completion of apartments. Of course, that's not good for those who've already bought them, and deprived the economy of a key driver. And while the latest economic data put the government's growth goal of about 5% well within reach this year, that could drop to 2.9% in 2024 if the property crisis deepens. As far as China concerns, a slowdown of that magnitude would practically be a depression. And yet authorities did step in. We made the case that it wouldn't matter as they attempted to halt the slide in recent months by unveiling fresh reductions in down payment requirements while also encouraging lenders to lower rates on existing mortgages. And despite that, home prices in September fell the fastest pace in almost a year, a blow to sentiment in a country where property has long been one of the main stores of wealth. Of course, if property prices go down, means spending goes down, and you start to see this downward spiral, and China is in every position right now to take the global economy down with it. And you can see here as their factory activity shrinks, fueling calls for more support. And you may remember last month that their factory activity, we'll look at the data, just ticked in a positive territory just a little bit, and everybody breathed a sigh of relief saying, look, there's a soft landing. China's going to rebound. We have 2 consecutive months of this big turnaround, and we said, don't buy into it. It's just a seasonal issue with the back to school, with the holiday demand. And once that leaves the factory, it's going to roll over and head down. And sure enough, it did. The official manufacturing purchasing managers index slipped to 49.5 this month from 50.2 in September. Of course, that's what everyone got excited about. That compares with the estimate of 50.2 by economists, everyone being optimistic here, except us, the non-manufacturing gauge. This is the services sector, which measures activity in the construction and services sector, declined to 50.6 from 51.7, beating the forecast to the downside. And we mentioned this, where the manufacturing sector goes, the services sector eventually follows. And sure enough, what have we seen? China got a little bit of a burst of a turnaround, and all of a sudden it's heading back the other direction, and that is a sign that global demand is coming down. The PMI numbers partly reflect seasonal factors due to an 8-day holiday at the beginning of October, but that also shows market demand remains weak, and there's the critical part. The new orders indexes under the manufacturing and non-manufacturing PMIs were both below the 50-point mark, indicating, as we've been saying, a contraction in global demand. It's an issue. It's affecting everyone, not just the U.S., but we're talking China, Europe. Everybody is being affected by this. And look at this, a contraction in export demand for manufacturing measured by the new export order index deepened this month, indicating the factories that sell to overseas, which is a bunch of them, are still under pressure. And of course, we know that that is what is going to drive the Chinese economy down. It's some big contraction in the creation of money, a big drop in global demand, and everybody's at a point where they're loaded up in debt. They can't handle any sort of slowdown, and yet we're going to see a synchronized slowdown across all global economies. And as you can see, now it's coming to America. But one thing we remain bullish on is our sponsor for today's show, Shapeways. Remember, they're the 3D printing company. You can, again, find them under the NASDAQ under the symbol SHPW. Now, what's really interesting about this company is in 2 weeks, they're going to come out with their third quarter earnings. I want you to think of that and where the stock's at and where the buyers are stepping in here, because they've been surprising Wall Street with their last earnings announcements. And while we have no information to suggest otherwise, we have a hunch that Shapeways is going to continue to put up some strong numbers, which could cause their stock price to move up as much as 33%. We'll show you that case here, but you can find Shapeways. Here's their information on their website. It's all in the description and pinned comment below. Now, we see this headline here as they're going to report their third quarter earnings here on November 14th. So keep an eye out for that. Now, let's look at the stock price and see where the buyers are stepping in here, because they did a reverse split and it jumped their stock price up, which is exactly how that works. And then the price fell down and there was a consolidation here. Buyers stepped in, but sellers were above. You can see the supply zone. The buyers are below. The sellers are above. This on the 90-day chart. And what happened, the sellers won out here, and the stock dipped down and it hit oversold territory on the RSI, and it's now poised to move higher. And I want you to see this here, because where is that red line or that volume profile line? It's at $3.15. We think the first move is right up into the supply zone, because that's how the market works. It moves between supply zones. The buyers are coming in here looking ahead of that earnings report, potentially sending the stock up as much as 33%. Now let's zoom in to the 30-day chart, and here you can see the momentum is building. It came down, hit oversold territory on the RSI, hit the same thing on the MACD. You got a beautiful positive cross. RSI momentum building to the upside. Again, this is a perfect setup when you're looking from a technical position. And look at what the volume profile line is, $2.80, suggesting we know where the sellers are at. That's the next likely path for the stock to go. The evidence now you're wondering is, where are the buyers? Well, if we look at the 10-day chart here you can see the buyers at $2.19. At the time of filming, stock was around $2.14, suggesting that a move up to that upward supply zone would indeed be around a 33% gain. Again, check them out. They're on the NASDAQ under the symbol SHPW. And as with all companies we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.